So, good morning, good morning, good morning.
Good morning.
My fellow panelists and me, the moderator, we have the toughest challenge today because we're standing between you and lunch. But when I end up in these situations, I usually have one thing that works for me, and maybe you can try it. I think of this as the appetizer, and it will go quickly, and then we'll get down to lunch for real. So, good morning again, everyone in the audience, physically with us and those virtually. And we're going to be talking about diversification, portfolio diversification. And to start, I will have two quotes. And the first quote is from a man that is very well known. And he says, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." Albert Einstein. I don't think there's anyone here who would want to disagree with him. No. So I will try a similar statement, someone not so famous. Hopefully you will agree with me, or we can have a debate over lunch. And that is, diversification is the ninth wonder of the world. Right? He or she who understands it reaps the gain. He or she who doesn't feels the pain. Maybe one day that will go down in the annals, but for the time being, we have three panelists who are very experienced in their lines of business, and they were chosen specifically by the fact that each of these panelists represents a specific investor group. We have Liz, our colleague at Sygnus. Liz works with high net worth individuals and family offices. And I told you how she works. She works with them in terms of bringing them the value. And then we have from Shane, as we heard, Shane represents Sagicor, and I would call Sagicor the financial supermarket. They have lots of customers, they have lots of products. Everyone comes in and takes something. So he tries to be most things to most people. And he will have a separate perspective. And then Keith, of course, well-known chairman, executive chairman of ATL Funds. And he, I would describe as the fiduciary. He only has one customer, and that's his pensioners. And he needs to make sure that when they retire, they have money coming in, that steady income stream. So, ladies and gentlemen, I'm going to ask you all the same question, and if you could tell me your experience. So we're going to explore the topic of diversification and how you use alternative investments to get to diversification, and what else do you do with it? It's not a one-tool instrument, one use. So I will start with Keith. ATL pension funds, why did you come in to the Sygnus group, and you were one of the first in the group? So please tell us why you did it and what you have gained from it, from your pensioners.
Well, we saw, everybody can hear me? No? Well, we thought that it's not on?
Oh, is it me? Oh. No, that's it.
Oh dear. Not on. Can you hear me? No.
Yes.
Okay. Yeah, we thought that Sygnus provided an alternative to
All right, finally. We thought that Sygnus provided a good alternative investment platform for our portfolio. So basically, a traditional pension fund in Jamaica has more limited options than, say, the global markets place. So we would have some stocks, some real estate, and some bonds. So we had gone, most pension funds had a fairly high allocation to government fixed income, until quite recently, maybe a decade ago. Now, what this meant is first of all, they had some shocks. They experienced some shocks when they had two debt exchanges, 2010 and 2013. So government paper didn't feel as good as it had done for years when you had 20% returns. And although some had real estate, including ourselves, and that's sort of like a stabilizer, you didn't have enough of it. And of course, the danger was that everyone's trying to buy real estate, although we have actually invested as well in Sygnus's real estate fund, and we think that they look like they know what they're doing, and they have some interesting deals. So basically, the alternative platform of a credit fund producing a credit type, fixed income type yield, better than what we were likely to get on government fixed income at that time, because the rates have been falling. That we said that will give us an extra return. It will be a diversification. It will be quite short in terms of the tenor, as Jason said. So we said, okay, basically, someone should do this. Okay, these guys are doing this. Let's invest in it. I think it's a good idea. And funny enough, I'd known Jason quite a while, for several decades, from his his time as a PSOJ economist and so on. So I said, okay, well, he's a smart guy. He's a smart guy. Not saying whether he's as smart as Nigel, but he's a smart guy. So I said, okay, and they look like they have a smart team, a good team. So that was part of the decision, that looked like they had a strong team. So we took I don't want to call it a bet, but we took a chance on the fact that they looked like they knew what they're doing, and I think we've been proven right. So we also invested in our real estate fund. Again, the original fund was a little bit different from a typical real estate portfolio, just buying a building, because they're trying to lay off the money like an investment banker. They can, I don't want to use the word recycle is the word that I want to use, not rinse. So we said that, okay, that looks a reasonable investment strategy. So they had two different investment strategies than we had the ability to really do ourselves. So that was the real reason we invested in that, and the fact that we thought the team looked very promising. And then there was some guy called Milton around who looked like he might provide some of the gray, I don't want to say gray hairs, but the experience that I don't think they said that you were a managing director of CIBC in Jamaica. I don't remember if they did, but some of us remember that. The best salesman managing director of a bank that I've ever seen in Jamaica, I would say that. Anyway, I'll leave you guys with that as a start off.
Just one addition, Keith.
Okay.
And one of the dilemmas that the pension industry faces is that lifespans are longer,
Right.
healthcare, which means that the payouts for each pensioner is going to be larger. How does alternative investment assist that portfolio in terms of giving yourself a better yield so you can meet pensioners' obligations?
We're looking for a higher. We don't want to have. We want a higher yield than, say, if we're just going to go into a fixed income instrument. As Minister Clark noted, his success has meant that in terms of macro stability, has meant that the returns you get on government fixed income, say in US dollars or in Jamaican dollars, is much lower than it was before. So we need a few extra points and over time, those few extra points compound. So, and so it can make quite a difference over time. Our time horizon would be 10 to 15 years. So we have a longer term time horizon as a pension fund, and that gives us an advantage. We can look through whatever the short-term volatility. So that's a key part of it. And also, what I would say is that the diversification, achieving more diversification than you can normally achieve in the Jamaican context, because obviously Sygnus has investments not just in Jamaica. So that's another part of the diversification that we're looking for. We're looking for things that are not only in Jamaica, that are not necessarily correlated to, say, what is happening in the stock market here, because we have quite a lot of stocks too. And when we started out, we bought them 5 times earning half book value. They're not like that anymore. Mm-hmm. So the more, as far as I'm concerned, the more alternatives that we can invest in at this time, the better off we'll be, as long as we do our proper due diligence.
Thank you, Keith. Okay. So we move to Shane, and you're the financial supermarket. You have lots of products that you make. As a matter of fact, that's one of your responsibilities in Sagicor. And you have pension funds as customers. You have industrials as customers, and you have private individuals as customers. How do you apply alternative investment to serve that segment, and do you use a different approach for which funds you might sell to a particular group of investors?
Right, sure. You guys heard me okay? Yes, great. Mm-hmm. So for us at Sagicor, the benefits of alternative investments are very clear to us, and really see them as complementary assets for any investment portfolio, really to achieve those objectives. And those objectives are really twofold. Of course, maximizing fund returns and effective risk management. And again, just looking on the environment in which we operate now, that high inflationary environment, trying to get a real return for example, pension funds, for which that's a key metric to try and outperform. The traditional assets not necessarily cutting that. So of course, alternatives has a huge role in terms of supplying and meeting that objective. Outside of that, on the risk management standpoint, which it's very key and essential and important for us also. The low correlation of alternatives to traditional assets, again, it helps in that regard. Mm-hmm. And just a little bit in terms of how we really use alternatives, I'll probably touch on 3 areas which would have been discussed earlier. Mm-hmm. So real estate development, from development to ownership, and again, that entire value chain can really supply different segments of the market. So you'll develop, take some construction risk, take upfront gains, and then over time, of course, the completed product, whether it's commercial warehousing, can flow into our investment portfolios, flow into our insurance funds. It's an ideal long-term provider of cash flows for these long-dated liabilities. So from that standpoint, from a return standpoint, real estate has great value there. Also for our risk mitigation strategy, would have all seen the impact of or the performance of real estate during the pandemic. It has been one of the most resilient assets. The contribution to GDP has been significant right through that volatile period. Again, of importance and benefit to a portfolio in a way that a traditional investment can do. Outside of real estate, of course, we move into, we also do private credit, structured finance, And, again, just to link it to currently what's happening here and, the transition in our markets over time, where, in the past we're accustomed to significant GOJ issuances, of high volume, high activities. That's no longer the case. It's a huge demand to try and get these assets. And as such, fund managers really do need a home to place these investments. So these again are, what I would say are ideal replacement assets to fill that gap, find a home for cash essentially.
Good.
And lastly, private equity, of course, which I just went through in detail all the benefits of PE, and we'll do that individually or through key partners, as we've done with Sygnus also. So those three areas, I think, main from alternative standpoint, those are areas that we do utilize, we do employ in a very significant way. And if we just look on what's happening globally as well, if we look on it's well documented, the Canadian model, there are huge allocation to alternatives, in some instances up to about 40-45%. Yes, our ecosystem at home has taken some time to grow, but if we look on how it was 10 years ago relative to now, significant improvement. And regulatory-wise, there would have been significant changes to facilitate more allocation towards this particular area.
Yeah, thank you.
Specifically in terms of how it solves some of our problems, we're in the business of trying to, of course, meet the needs of our clients. Again, our clients want return, but how you go about getting that return is also very important, is very key. And that, again, ties into the risk management. And alternatives help in that regard, where we all know that in terms of strategic asset allocation, that's really a key pillar or the fundamental factor in driving long-term or returns over the medium to the long term. And again, alternative investments has a huge role to play in terms of trying to achieve that. And if I was supposed to add anything else, it really would be that in the current investment climate in which we operate, it has become very complex. From an investment manager's standpoint, the usual 60-40, 70-30 portfolio is really just too simplistic to use in the current environment. And if it is that you really don't have alternatives in your portfolio, I think you're really doing your investment portfolio a huge injustice, and by extension, clients, beneficiaries are the one who you're investing for.
Right, thanks. So tying back a few of your comments to Barris's presentation, and many people would assume that we are competitors, but the reality is that we are collaborators. And so this idea of growing the ecosystem, more players in there, means that we can do bigger and better things. So Sagicor is a special investor type for us in terms of not only equity investments in the different funds, but they also invest alongside us, which means that they really believe in this concept and work with us in many different dimensions. So thank you. All right, then that brings us, last but not least, my colleague, Liz James. Maybe you want to...
No.
Is it working?
Yeah.
Yes. So Liz is in a unique position in Sygnus. She looks after the high net worth individuals and family offices. But she is closely tied to the private equity business because, as you heard from Ike, an owner gets concentrated. Their business is 90% of their net worth. And if you wait long, something may happen, and the moment you want to retire and sell the company, the market is down. So there's a huge concentration risk that company owners have. They also have liquidity risk. Many of them I've spoken to are asset rich and cash poor because they have plowed back everything into the business. They just barely take a salary. And at some point, they should be able to take some money off the table, a liquidity event. And I also spoke about the succession planning, how we help companies to navigate from that medium-sized company and go on to the global stage. How do you apply these products with your clients in terms of solving their diversification issues as well as their any other issues they may have around liquidity and succession planning, so forth?
All right, so let me go back a bit. So I just wanted to give some history.
Not loud
So
enough.
portfolio diversification is one of the most important tools in investing. And it's really, it's very impactful for the investors to understand why they have to diversify the portfolio. For the last 10 to 15 years, most of our private wealth, high net worth, and even retail investors have really been concentrated risk in emerging market bonds, different types of notes, corporate bonds, sovereign debt. You would say 70% of the portfolio have been in fixed income. And with the development of the cap markets in the last couple of years, they have been taking some equity exposure. So alternatives to me is, the clearer path for our clients and our investors to be able to manage their portfolio for the long term, protecting their legacy and their intergenerational wealth. It's an asset class that is not correlated with the traditional assets, and it's very important for private investors to know that. And as Sygnus, we continue to educate that journey. I would say 5 years ago, none of my clients knew about alternative investments, so this is just the start. And alternative investment is such a large asset class, so we really do a needs analysis, risk tolerance approach to each individual client, and we find out which ones suit them both locally and internationally. So back to your question, Milton, about the diversification approach. One thing about Sygnus is that we put our clients in the middle, in the universe. They are the center of everything that we do. We are users of alternatives, but we have our investors who have been with us from day one. And, in that sense, we really wrap ourselves around the client. So through their journey, their financial journey, from, I don't want to say we're a family office yet, but we're definitely getting there. So we go through the whole cycle of managing and diversifying your portfolio actively, to include alternatives, of course. And then, we do succession planning, we do tax planning through Sygnus Tax, and of course, estate planning. So we really want to complete the full circle around the client. And with that, then we move into exposing them to our alternative investment platform, but also our international platform. So when you think of a client, a business owner, and they have all their risk in their business, and as you said, no liquidity, through Ike and the private equity team, a lot of these clients, they're partners, they're relationship. So at one point, they're an SCI client, another point, they're a real estate client, and they get to know us, and we really, wrap ourselves around them. So the succession planning, a lot of them are my clients, they've done well, and they're reaching their 70s, their kids have migrated, and they just really want to still be a part of their business, but allow, get some liquidity so they can start enjoying life a little bit. And we basically give them that opportunity by partnering with PE. We invest in them, and then we take that funds and we really manage it so that they can have intergenerational wealth for their family and legacy.
Good. Thank you very much. So we have 3 different perspectives. And so at this point, I'd like to thank the panelists. and open for questions. And we have questions from the audience we'll take, a roving microphone, or we have questions online. So we'll take them. Please state your name and the organization you represent, and direct the question, who your question is directed to.
All right. Thank you so much, Liddell Robbins from BlackRock. My question is actually for you, Keith. If you could take us through a little bit about your allocation policy with ATL Pension, so what your kind of constraints and limits are with respect to different asset classes. Be helpful.
Thanks very much. Well, there's a number of constraints, and it's something we should probably get into more detail on. But currently, for example, we have a 20% constraint on foreign exchange instruments, but that's from a long-standing act. But the Bank of Jamaica has imposed additional constraints using its regulatory power, so over the foreign currency. So there was a long-standing sort of 5%, which was it wasn't a real 5% in the sense that you still were supposed to apply to the Bank of Jamaica for it, but it was understood. They communicated 5% as what they were comfortable with. Now they've raised the amount of money to 10, but so 10% of a pension fund can be in foreign exchange, but a lot of pension funds, were already at the 20. Some of them had got specific Bank of Jamaica approval. Some of them were even above that, even though that would have been outside the regulations. So the 10 did not look so attractive to all those people at 20 or above, which no doubt was part of their intention. In addition, they recently changed the regulations to carve out a specific 5% for private equity. Well, it's actually private equity and debt. Now, that was not as positive as it appeared at first glance, because although they said, okay, if you're listed or if you're rated, then you can be outside of that sort of 5%, if this is really applying to debt now. What that did is, because of the situation we had here in Jamaica where you'd had this crowding in effect that was talked about previously, that meant that quite a lot of corporate debt, a corporate debt market had emerged post the debt restructuring that had occurred. So you had I would say for the first time, in the 90s you had a commercial paper market which wasn't quite the same, but that disappeared. But so a corporate debt market had appeared for the first time over that 5-year period, probably between 2015 maybe, and 2019. And a lot of pension funds had, gone into that market as an alternative or supported that market as an alternative to government fixed income, which was falling in the yields were falling. So a lot of them already had that bucket full. So one of the things I think we need to do, and this was certainly lobbied for by the Pension Fund Association Jamaica and so on, is we had expected that there would be a 5% equity and a 5% private debt at minimum, so an overall 10%. Some of us, such as myself, even thought that we should be aiming for more like 20%, not necessarily, day one, but over time, so maybe a phased approach. But the problem in Jamaica is if you don't actually put something in legislation, it takes a while, it may never happen. So I thought if we had some kind of phased approach, that would work. Now there's an additional problem that was created by Bank of Jamaica restriction, which was that they reduced the investments that you could invest in. So you used to be able to invest in US, UK, Canada equities, as well as Jamaican equities. So they put in as a restriction coming out, I think it's coming out of the crisis, basically narrowed what you can invest in to exclude that for the moment. So that's again by Bank of Jamaica regulation. So my view is that it cannot make sense for us to effectively say that we can't use the largest stock market in the world, or your other stock markets, in fact the G20s and so on. We could probably think about broadening. We had hoped that actually we're going to broaden it beyond the US, UK, and Canada, which of course are the traditional markets. But certainly the US market, everyone here would be using the US market as their benchmark, so that is another problem. So we believe that alternatives, and that's part of our strategy. We've invested in I would say, we've been a catalytic investor in a few and invested in a number of others. So I'm not aware of a pension fund that has been more aggressive than us in terms of finding alternatives in Jamaica. And we've done that deliberately because we wanted the diversification and we wanted it to different, whether the real estate strategy of an investment banker for real estate, we thought that was a good strategy. Actually, we thought of it ourselves. But anyway, I knew I wasn't going to be allowed to do it, so they even found the same guy to help them with it. So we thought that was a good idea. And we also liked the credit strategy because we thought, okay, you should be able to do better yields than, some of the corporate debt that we see. Because we didn't really like the truth is we weren't that keen on some of the corporate debt yields, so we liked the ones with a few points higher extra protection, which is what Sygnus was doing, to try and find those slightly more difficult deals. So that's, I could go on, but I don't want to go on. But that gives you some idea of the constraints. We can actually invest in pretty much virtually unlimited in real estate, but that is probably not a good idea to invest the entire pension fund in real estate. I'm pretty sure it's not actually. But there are limitations on us investing, say, in mortgages or US real estate as in a direct investment. So the issue is can an alternative investment can we invest through alternatives into other strategies that we can't do from a regulatory standpoint at this time. So hopefully that gives you an idea, and I'm happy to have a further chat with you if you want some more details.
Thank you, Keith, for that comprehensive response. We have one other question here, and that is for Shane, and it's, how do you determine the portfolio allocation of alternatives for your clients in this current environment or fund, in this current investment environment?
All right, thanks for that. And I mean, that's a very good question. So essentially, portfolio allocation, it's really predicated on the beneficiary, who is the investment for. So it varies dependent on, I guess, ultimately who the client is. For pension funds, insurance funds, there are some similarities there in terms of the long-dated nature of those liabilities. So to step back a bit, essentially what we'd have a look at are really capital market expectations, from a long-term view. How do we see locally our macroeconomic trends going, and also plug in further afield in terms of essentially global trends that we're seeing. And essentially from there, again, if it's long-dated liabilities that are defined, we'll try and kind of match essentially with alternatives that can fit that need. Again, case in point, real estate. You're getting two spin-off benefits. There are your annual revaluation gain from your properties, and then, of course, those long-term cash flows that escalate with inflation, again, which is ideal for pension funds. And, on the insurance side, through the actuaries, we'll collaborate in terms of trying to identify what would be ideally the right fit there. So that's the general approach in the main. Again, for the other buckets of clients, unit trusts or your CIS clients, the approach may be a bit different. Again, they're probably in and out a bit more transactional. So you're really creating structures, funds with set mandates and strategies. And once clients are invested in that, then they really know what their exposure is, what risks are underlying in the portfolio, and how it is you expect to get yield and return.
Okay, thank you for that, Shane. And that takes us to the end of this first Fireside Chat. And I'd like to thank the panelists, Keith Collister, Shane Walters, and Liz James, for your sharing your thoughts with our audience here and those online. Thank you all.